show Rich and
All right, hello everyone. Welcome to another special edition of Governance and Risk Call. Thank you to everyone for joining us on this Wednesday. Having a few extra calls this week so that we can just tackle more fun governance stuff. Today we have another special presentation from the risk team. Vishesh, Primosh, and Marko are going to talk about some really awesome research that we have all collectively been working on. I think we can go ahead and get started with that. Are there any maybe outstanding governance items that we want to tackle first with this extra time that we have? Long for wisdom. Is there anything that you can think of from yesterday to today? I think maybe another reminder about the delay post SCD shutdown in terms of when the delay after when the spell is cast to when the shutdown actually occurs. Other than that, all right, so then I'll just talk about that quickly. So as most people are probably aware by now, I think April 24th, single collateral DAI is scheduled to shut down per an executive vote. Given that the timing of the executive vote is sometimes not, it's pretty much random, it has the potential to mess with a lot of people's GUIs, interfaces, and whatnot. Causes a significant amount of complications for our collateral partners and our integration partners. So the idea is that regardless of when the spell is cast, it would then trigger that true shutdown at a predetermined timestamp, say 1 day later, something along those lines, to give people sufficient time to prepare for it. Does anybody have any thoughts or comments on that? I don't know if there's much to discuss, really just putting out another PSA for this.
Cyrus, do you know how long that delay might be?
I don't actually. I think maybe a day, I think, is what was maybe suggested, or maybe 12 hours.
Okay,
Kurt, or somebody else, do you have some color on what, or maybe someone from the integrations team? Any of the devs have an idea on that? Kurt or Will?
Could you rephrase the question?
So when the spell is cast for SCD, that there's discussion of putting in a delay before it actually gets shut down. Do you know roughly how long that delay might be?
No, I really don't.
I think it's completely up to the community, right? Like whatever the agreed upon value is can be put in. If you want an opinion, my opinion is that it, should be a fairly long delay, maybe a month or so. But that's just, one person's opinion. So.
Yeah, that'd probably be one just good to bring to the forum to try to get a specific number. I do kind of agree on a long delay, like a month or at least a week or two or something like that.
Oh yeah, that definitely broadens the discussion a bit. I was under the impression it would be a short delay, but that totally makes sense. So yeah, this should definitely go to the forums for some further discussion. Do one of you guys want to make a forum poll about, or a forum thread about this?
About the delay to shut down SCD?
Yeah.
Sure, I can do it. I just put up a poll on the GSM delay, so it's related, but yeah, I don't have a problem doing that.
Okay, cool. That being said, I guess we'll jump into the risk stuff if there's nothing else. Give me 1 second.
But first, so it seems that a month was the kind of resonated with people in this call. It's pretty long period of time.
Yeah, that's significantly longer than I was expecting.
I didn't expect that as well, but I mean, just maybe we get like a straw poll sometimes with the people and the folks in this call.
What's the reasoning behind this delay?
So a lot of makers, integration partners, and collateral partners, right? It would be a significant disruption to their business if SCD was shut down like a switch, versus if there was, once it was confirmed to be occurring, as per the executive vote, there would be some wind down time where they could gracefully handle the transition in their internal systems.
I think there are at least two
UIs.
other arguments for it as well. One of which is that the timing of a vote passing is unpredictable, and so you don't really want you want to have a predictable time, so that the shutdown isn't just determined at the last minute, and people can actually be ready for it when it happens. And then the other one is you don't really know if we're actually going to shut SCD down until a vote passes, right? You might put a vote in and say, okay, it's going to shut down whenever this thing passes, and it never actually passes. So you've got to pass a vote before you even really announce that you're shutting it down for sure. And you don't want to be like announcing, okay, yep, it's definitely officially shutting down 2 days from now. Like once the final vote passes. Like that's why I argue for a longer delay, is that you don't want to make the announcement until you've actually passed the vote and it's going to shut down for sure.
Right, that makes sense. Thanks.
All right, cool. Well, let's move on with the agenda bit. All right, so I got to read this this disclaimer one more time, and then we can get started. 1 second. Okay, so general disclaimer. This communication is provided for information purposes only. The views expressed here are those of the individual Maker Foundation, personnel quoted, or who present said materials, and are not the views of Maker or its affiliates. This communication has been prepared based upon information, including market prices, data, and other information from sources believed to be reliable. The Maker has not independently verified such information and makes no representations about the enduring accuracy of the information or its appropriateness for a given situation. This content is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. You should consult your own advisors as to those matters. References to any digital assets and the use of finance-related terminology are for illustrative purposes only and do not constitute any recommendation for any action or an offer to provide investment advisory services. This content is not directed at nor intended for use by the MakerDAO community and may not, under any circumstances, be relied upon when making a decision to purchase any other digital asset referenced herein. The digital assets referenced herein currently face an uncertain regulatory landscape in not only the United States, but also in many foreign jurisdictions, including but not limited to the UK, European Union, Singapore, Korea, Japan, and China. The legal and regulatory risks inherent in referenced digital assets are not the subject of this content. For guidance regarding the possibility of said risks, one should consult with his or her own appropriate legal and/or regulatory counsel. Charts and graphs provided within are for informational purposes solely and should not be relied upon when making any decision. The content speaks only as of the date indicated. Any projections, estimates, forecasts, targets, prospects, and/or opinions expressed in these materials are subject to change without notice and may differ or be contrary to opinions expressed by others. All right. Did that unmaximize the screen? All right, so today we're going to do a more detailed overview of the model. We're going to talk about some of the different risk factors that are embedded in Maker risk. And then at the end, we can do Q&A and maybe a demo. So I think from here, I think we're going to be sharing the presentation amongst the different risk team members. So I'm going to pass it off to Vishesh at this time, and then he'll take it away from here.
Okay, so yeah, in general, just wanted to kind of marry yesterday's overview with today's presentation. Yesterday we talked about a lot of the concepts that go into what risk is and how we would apply the model to try to help determine what are reasonable values for some of these output parameters. So just at a very high level, the point of what we're doing here is to, at the end of the day, derive these outputs. The process that we use basically takes into account what we have available to us as inputs and sort of best practice methodologies given a lot of the nuances and constraints of how crypto assets work. So yesterday we kind of talked about at a very high level what some of these methodologies are. Today we're sort of going through in a little bit more detail what some of the mechanics and the data and analysis that go into developing these methodologies. So, oh, we lost the.
Sorry, give me 1 second. I'm just rearranging my screens.
Yeah, I'll continue that. So the general process then becomes deriving these outputs using inputs such as existing parameters that are not sort of dependent variables. So those are your independent variables. And then also using data and analysis like, you know, qualitative analysis, historical analysis on market price movements, historical analysis on user behavior, etc. So to recap from yesterday, the outputs that we're primarily trying to derive are expected losses and value at risk. So effectively, the values that allow us to determine what are reasonable stability fees and debt ceilings based on some traditional finance methodologies. And the general process, again, as mentioned yesterday, was due to a lack of robust historical data on the assets that would potentially be used as collateral, and due to the fact that collateral risk is the prime source of risk that we're trying to model in the system, we've taken kind of this stress testing Monte Carlo approach. So in doing so, what you basically have is kind of this feedback loop of you assign some inputs, you run many different iterations of the model, and then those produce your outputs. And then you can sort of plot, graph, determine, okay, based on the outputs, do you need to make an adjustment to the inputs? And that's just kind of a general methodology for modeling, not really specific to Maker, not really specific to finance. Actually, it's just generally how you do modeling. So the specifics to this approach in this system are that we're modeling collateralization ratios as the prime backbone of the quote unquote methodology. So pretty much everything up to the point of saying, here is how prices would potentially move, and here's how collateralization ratios would move accordingly. Pretty much everything before that is either historical analysis, just purely looking at data, or is kind of basic common sense structure of how the Maker system is laid out. A lot of the magic or the nuance in how this model is structured is about how you look at those collateralization ratios. The reason being is those collateralization ratios, as we talked about yesterday, primarily determine what your liquidation amounts are, and basically how much you liquidate and when you liquidate it. That aggregate tells you how much you're going to lose through the system. And then, as you can probably guess, modeling out how much you stand to lose in the system is primarily the goal. And then you're just slicing that up a few different ways to determine risk parameters. So at a step-by-step, that's basically using those inputs to model how you expect collateralization ratios to fluctuate over time, taking those collateralization ratios, pushing them through a very simple calculation to determine liquidations, taking those liquidations as a time series, and applying through some historical analysis, but primarily basic formulas, a amount that is lost through slippage as well, and auction efficiency. And then basically that final adjusted amount that is lost is the prime goal of what you're trying to model. So again, at a comparatively high level, that's the structure of the model. And then we'll go through a little bit more detail. Next slide, Cyrus. So 3 main components to this, as I alluded to: the asset price, that's primarily your independent variable; the collateralization ratios, so these are, like we just talked about, a function of that asset price, but also some user behavior. And then at the end of the day, you take those amounts and you adjust them through some historical market analysis, and you get your final losses through slippage. The asset price, we're modeling using geometric Brownian motion. So that's a pretty, again, as mentioned yesterday, a pretty well accepted methodology for stress testing random walk processes like asset prices. The collateralization ratios. So again, if you had no user behavior applied, collateralization ratios would just fluctuate perfectly one-to-one with the asset price. But in reality, we know that the collateralization ratios in lending platforms in general, and Maker specifically, do not just fluctuate one-to-one with asset price. And so there's certain patterns of behavior that you need to adjust those values through. And that's where the historical user behavior analysis comes in. And then, I don't want to beat the horse to death, but the slippage amounts, basically, the basic concept, which, our team will go into more detail later, is when you sell more in shorter time frames, you make less money back on the amount that you sold. And so we have to adjust again by that. Next slide. So again, for the purposes of this model, it's not well suited to just extrapolating from historical data. So we have to take this more stress testing Monte Carlo approach. It's flexible enough to allow us to incorporate certain custom adjustments for nuances for how crypto works and the kinds of risks that we expect to need to be prepared for in crypto. As was seen recently, you can have these sort of seemingly random jump events in assets where no indication from historical volatility, and then suddenly there's a major price drop. These kinds of things happen in crypto because it's a young, immature market, and a lot of these assets are hugely technical. They're not just large traditional public equity companies. They're very technical projects, so very impactful things can happen suddenly. And then it allows us to incorporate a time component to the model. So if you think about a stability fee as an annual value, so being able to look at annual losses is a helpful layer for lining up a frame of comparison. So you have a lot of control over these kinds of parameters in a Monte Carlo approach. So that kind of simulation testing is in our opinion, well suited for the problem that we're trying to solve for. And I've already beat to death why we're not just using historical sampling, though it is an incorporated component. Next slide. Yeah, so I'm not going to go through every one of these line items, but in general, the Monte Carlo simulation has a parameter to it, which is, I would bucket these 3 sets of parameters like they are listed here. So essentially, there's stuff about the model itself, kind of meta parameters. How are you running the simulation? How many times are you running it, etc. There's things about the asset price. So I'll go through this in a little more detail later, but essentially when you have these random walk processes, there are a lot of things that go into it, like how long you're modeling the asset price for, how detailed are your individual time steps. There's 2 main parameters when it comes to Wiener processes. They're called mu and sigma. They can be thought of as kind of this annualized log normal drift and log normal volatility. And essentially those parameters determine in what direction the price path will move and how violently it will move along the way. And the collateralization ratios, so obviously a lot of the parameters that go into determining what the collateralization ratios are existing system parameters, like the liquidation threshold, the penalty, etc. These are not things that we necessarily are fluctuating or moving very much in the model. It's more of, for a big run of the model, you're going to try a different, think of it as a vault type, right? So currently you have ETH with 150% collateralization and 13% penalty. That's one potential set of parameters. You could also run this to try and see what things look like if that vault type were different, if it had a higher collateralization requirement or a lower one. So that's, again, a very helpful facet of the kind of model that we've set up here. And then the final point, sorry, Cyrus, I think you're mouse screen. Yeah. So for the slippage component, the main thing there is deriving a function that tells you roughly if you're selling X amount, what amount Y are you going to be able to recover. Next slide. Yeah. So now Marko will run through how we sort of back our way into specific loss events and specific price movements. How much is the price graph going to move and why, and sort of how we incorporate that data historically into our model.
Yeah, hello guys. I'm going to talk about jump risks, what they are, why they're important, and how we can use them. Basically, here we are showing this picture once again because it is very related to jump risks. Basically, if we have small price changes over time, they will generally create positive flow for the protocol because of the liquidation penalty, while severe high price changes will potentially create under collateralized liquidations and generate negative flow for the protocol. Next slide, please. Here is basically another illustration of this. On the left picture, we can see Ether's price up to 2020 almost. And basically, even though the price decreased for, you know, like large amount over high period of time, basically protocol didn't generate any negative flows. And on the right, we have like an example of price drop, which could probably activate a lot of liquidations and generate a negative flow for the protocol. Next slide, please. Okay, so basically definition of jump risk is severe negative price change in short time period. And basically short time period is not exactly defined. maybe logical approach would be to use hourly returns because of the 1 hour OSM delay. But in reality, we know that there are multiple factors which actually play a role here, like OSM could be additionally delayed, or auctions could be postponed, or network is highly congested, or market is just not efficient. And basically there is not like one exact time period which is perfect for analyzing this. Basically, how we can use the jump risks is that, for example, for ETH, like if we just consider historical volatility of ETH and put some kind of drift into the model, we will generally not generate like very large price changes in our price pattern. So we will generally only produce positive flows because of the liquidation penalty. So we definitely have to somehow incorporate them in. Then additionally, some assets which might be considered for potential collateral type simply do not have long enough trading history. And then some assets like might have long enough trading history, at least to crypto standard, but that they just simply didn't experience any kind of risk which we know that it exists. Like for example, best example of this kind of assets would be fiat-backed stablecoins, where we basically know that there is some counterparty risk because they are centralized. And in addition to counterparty risk, they're basically tokenized dollars, and they can be used to transact globally. And basically different governments around the world do not really like people to be able to send dollars around the world without any restrictions. So we can somehow estimate that there is high chance that there will be some regulatory issues with them. But like if we would just consider historical volatility of, let's say, USDC, we would basically see that volatility is very small. But like if we actually want to test it right in our model, we necessarily need to add some additional jump risks. Then let's talk about triggers. Basically, when we started to research what are the triggers for these jump risks in general in crypto, first we conducted historical research of daily returns on Ether. And basically we try to estimate or determine what are the most likely causes for largest 30 negative returns. And basically what we found is that almost 75% of these 30 cases were actually due to some kind of systematic factor. So basically this factor influenced Ether and also Bitcoin and other assets. And then basically just with what we already know from, just being in crypto for some time, we basically we created 4 categories of jump risk triggers. The first one are exchange hacks. These are basically mainly just theft of funds. And basically the most severe outcome of this category is if some exchange just becomes insolvent, and this creates large panic, people start selling, and it's just like really bad. Then another category which we picked is technological vulnerabilities. In this category, we basically include any kind of technical bug vulnerability which could be exploited, either on like blockchain layer or on some application protocol layer. Then another category is governance related issues. Now in history of crypto, we only had 2 large such events. The first one was when basically Ethereum community couldn't reach consensus on how to deal with the DAO hack, and basically split it in 2 blockchains and also 2 communities. And another was similar example on Bitcoin, where people just couldn't reach consensus how to approach infrastructure in the future and basically split into Bitcoin Cash and Bitcoin. And then last category is regulatory issues, which I think I don't need to really talk about much. Sorry, yeah, can you go to the next slide? Okay, so what are the parameters of jump risks? Basically, they have two main components. One being frequency, basically how many times per some time period this happens and how severe these price changes are. Now, both of these components can be determined in many different ways. For example, for frequency, we could just analyze historical events and say, for example, we had 10 hacks per 10 exchange hacks per year on average, and thus we should just use this as our frequency per year. Other approach is by creating a scoring framework, which through a system of different questions tries to estimate how exposed particular asset is towards a category of risk. And then another approach is mainly for stress testing, is to just use some kind of constant. And in this case, we are just testing what would happen under such conditions. Severity is the same. It can be used as constant for stress testing. Like example of this would be if somebody who is analyzing this protocol would say, we want to be protected against, for example, 70% price drop once per year. And they could just, put these inputs into the model and then observe different behavior of these factors and outcomes. Like here, I want to point out that jump risk is like really important input because it is the main cause of liquidations. But at the same time, it's like highly subjective because it is really, really hard to quantify or somehow objectively define frequency and severity. Next slide, please. Basically how we approached jump risks is that for frequency, we created this scoring framework. It is definitely not like, it can definitely be improved, but what is the important part of this scoring framework is that the general idea behind this is that through a series of questions, we try to determine how exposed is particular asset towards one particular jump risk category. So for example, for exchange hacks, like asset which has almost no supply on custodial exchanges have like, even if they're hacked, the severity of this will be small. And then at the same time, some crypto assets actually have some kind of fundamental functionality in the underlying system. Example of this is proof of stake based blockchains, where you can, actually produce blocks with coins. And another example is application layer protocols where token is used for voting or also some kind of staking or something like this. And basically assets which have such functionalities are logically additionally exposed toward exchange hacks. Yeah, this is basically logic behind the scoring framework. Now we can move to the second portion, which are severities. Next slide, please. Basically, for severities, we decide that we want to analyze historical events which fit into our 4 categories. So this is example of like largest exchange hacks in crypto. And like our exact methodology here was that we considered daily and also intraday price changes of the day when events happened plus 10 days. So in this 11-day time period, we picked the most severe price change to determine the severity of, like for example, Bitfinex hack. Next slide. Yeah, here are proxies for other free groups, technological governance and regulatory issues. Basically, we have much less of these events which actually happened and we could measure. But like, you know, this doesn't mean that they will not occur again or that they would have higher severities. Basically, like the highest severities here in this set are in technological and regulatory issues. Hey, Cyrus, can you just jump to the previous slide, please? I forgot to mention something there. Yeah, I just wanted to say here that, like, as you can see, we measure different kind of metrics. For example, asset amount divided by trading volume or like market capitalization at that time to like try to determine, is there some kind of distinctive correlation between, for example, how many coins were stolen and, you know, what is actual severity of this event. And basically, if you look at the bottom, there is the Upbit hack, which recently happened. And basically, this particular hack was the largest Ethereum Ether hack in terms of coins. But as you can see, the severity was like minus 3.5. So it's basically like any other day in crypto. So yeah, it's like really, really hard to objectively determine these events. Yeah, thanks. This is basically it for my part.
Hey everyone, Primož here. So liquidation discount is one of the core components of the model. Discount is closely related to slippage in a way that when we have an auction triggered, we need to assess how high auction keepers will bid in order to determine losses or revenues for Maker. Now, there's many variables that affect the bidding of keepers, and I'll go through them later, but the two main are liquidity of collateral and liquidity of DAI, and they both produce slippage. Now, this slippage can have two effects in terms of losses for Maker. It can either reduce the DAI recovered, and it can cause even the liquidation that would otherwise be profitable to potentially become a loss, or it can worsen an existing loss or under collateralization, which of course makes loss even more severe. We use two kinds of inputs in the model for modeling liquidation discount. First is the slippage curve, which essentially tells us what percentage of slippage Maker might expect while liquidating a specific type and amount of collateral. And basically we get an answer of how much below market price of certain collateral will keepers bid during the simulation if of course auctions are being triggered. The second variable is called auction efficiency. This one uses non-liquidity related variables, and of course this additionally affects the slippage in auction. Next slide, please. Okay, so here are some variables we've been using for modeling slippage. I'm going to describe them one by one. So the first source of slippage is based on collateral liquidity. If you think about it, when keepers obtain collateral from auction, they normally sell it on either decentralized or centralized exchanges for a stable asset or dollar denominated asset or fiat. Now, if this particular collateral is illiquid, keepers will bid at least as low as the slippage they would incur when they recycle this asset into a stable asset. How we model this liquidity is that we used very conservatively chosen volumes at the most liquid centralized exchanges, and basically used only the stablecoin pairs because most likely keepers will prefer to close the arbitrage cycle through those pairs. Additionally, we compare those volumes with price changes historically, and this basically helps us assess price elasticity, which tells you how the price actually impacted, how the volume that was historically made, how it impacted the price through a temporary or permanent price shock. So basically also telling you if keepers would be selling this amount, how much additionally you could expect price to drop. The details about this are going to be published in documentation materials later. For now, importantly here is that we want to stress out collateral slippage is based on secondary exchanges, and volumes were very carefully chosen, conservatively chosen, because we know there's a lot of fake volume on many exchanges, so we're really cautious here. The second important source of slippage, as you can see, is DAI liquidity or DAI slippage. We know that during volatile times when liquidations are triggered, DAI can start trading with heavy premium. We saw that. Of course, this becomes a problem for keepers, especially when they potentially need to acquire DAI before they bid. We know DAI markets are shallow, and that's why we need to know at what price keepers would be able to obtain DAI needed. So here, we mostly relied on order book analysis, just looking at most liquid DAI pairs to assess the DAI liquidity and at what price keepers can buy it. And then this results, the DAI slippage, these results produce DAI slippage curve, and this is combined with the collateral slippage curve that I mentioned before. Now, the third input, equally important, if not maybe the most important, is the total keepers reserve, which is sort of a hard cap on auction size, after which we may start seeing zero bids. So imagine if we assume that keepers have only 10 or 20 million of available capital. This means after we breach the 10 million auction notional value, we would most likely see zero bids coming in, leading to huge losses. So something like on Black Thursday. But apart from just assuming some amount of capital that keepers hold, we also need to know what amount of that capital is denominated in DAI rather than just in something else. Because if DAI reserves are small, we would expect keepers to either buy DAI, which leads us to slippage that I just described earlier, or they need to mint it by using USDC Vault, for instance. In any case, keepers would have minting costs or slippage buying DAI, and of course the slippage curve worsens. And then the final, the fifth input is the target profit for keepers. Of course, if expected profit for keepers is higher, this again worsens the slippage curve. Next slide, please. Okay, so here we have visual representation of how one of potential slippage curves we've been using for the model looks. You can see it combines both collateral slippage, in this case Ether, and the DAI slippage into one function, which is the yellow line called auction slippage. This is basically the slippage curve. Not really, the slippage curve is the green one. I'm going to explain later why. You can see this yellow line is much more flat at the beginning. And that's because we assume keepers have enough DAI capital at disposal, and Ether slippage isn't really present at those values. So we mainly just assume keepers would bid as low to have some profit, which you define. Once we reach a certain point where keepers either need to acquire DAI on market or they need to mint it, the slippage curve becomes much more steep and starts to primarily behave according to DAI slippage we measured. So all of these 5 inputs I mentioned are used to calculate the slippage curve. Here I want to make sure the community knows this is only one of possible ways. Many other techniques could be, of course, applied. The model uses slippage curve as a function. Currently, this is the 4th polynomial, polynomial of 4th degree. That's the green line, and this is fitted to the yellow line. But basically, anybody can use any function it likes or thinks that it applies better. Can be much more flat, can be steep, whatever user wants. Next slide, please. Okay, so the next input for liquidation discount is called auction efficiency. So this input tries to capture all the non-liquidity related metrics that impact potential losses from auction. It mostly addresses the issues that were experienced on Black Thursday. And these were something like network congestion, low number of keepers, for instance, reliability of keeper software, and time to bid duration, and so on. This input ranges from 0 to 1. 0 being totally inefficient, auction 1 totally efficient. In any case, whatever number you choose, this applies on top of the slippage curve that I showed earlier. So you could imagine that the curve that we plotted before, the slippage curve, would be then moved upward or downward depending on what input for auction efficiency you set. We've been using numbers from 0.9 to 1, meaning additional maximum 10% slippage, and this is applied on top of the slippage curve, for example, the one we showed. The number is highly subjective, of course, so community here can, of course, decide on its own. Next slide, please. Okay. So exposure risk. This generally applies to behavior function that Vishesh described. What we primarily want to model is how vault user behavior impacts portfolio exposure. We know that MakerDAO vaults are quite unique in the sense they have no maturity, they're non-recourse, which means the exposure is primarily a function of collateral price, but also of vault user behavior when users either add or remove collateral or repay and issue debt. And this exposure is best measured by just simply looking at collateralization ratio of vaults. In other terms, at the distribution of collateralization ratios. Distribution means we have to assess how much debt is owed at particular collateralization ratio ranges or so-called buckets. Now, why this is important, it's simply because it impacts the liquidation probability and severity of losses, which we are, of course, all interested in. This means we need to model how vaults users behave when collateral price pushes the collateralization ratio up or down. And what we know so far is that users tend to add collateral or repay debt once the collateralization ratio starts decreasing to levels where they might get liquidated. But we also know that if collateral price rises, they tend to remove unnecessary collateral. Now, importantly, this means that portfolio exposure can be less volatile than the collateral price itself, at least when we have collateral as Ether. In other words, if vaults wouldn't be making any collateral debt repayment, Maker would have huge losses in 2018 when Ether price fell more than 90%. So how we approach this issue? We simplified vault behavior and implemented so-called behavior function, where we model mean reverting collateralization ratios. This means exactly as we wrote here, vaults maintain their target collateralization ratio throughout the simulation, but with a specific time lag. So this time lag is important, and it needs to be set differently for different tranches of collateralization ratios. So just one example is if price falls and pushes the collateralization ratio distribution down, let's say you have a large amount of vaults near 150%, you would see a faster reversion process, right? Users would normally act in a day or two, maybe like at the same moment, and try to protect from being liquidated. And this can avoid liquidations, right? If they behave as such. On the other hand, if you have some vaults, usually when you see a vault with 500% ratio, collateralization ratio, and the price drops, this user might not really react, right? It may take many days or simply he wouldn't react. Next slide, please. So here you can see two charts. First is the collateralization ratio distribution observed in 2018, 19 at a single collateral DAI. You can see distribution was actually pretty stable, at least compared to it when it dropped more than 90%. And this is exactly what we try to somehow simulate in the lower graph, which is already a simulation. The model, what you set as an input in the model is simply initial collateralization ratio distribution. And this one is maintained through the simulation by responding to collateral price impacts, but with a certain reversion time, as I described earlier. So faster reversion or less days needed for lower collateralized vaults, and slower reversion time or more days for higher collateralized vaults. Next slide, please. Okay, here is showing one example of the model inputs. So first, initial collateralization ratio distribution is set. This could be anyone that user thinks should be maintained in some sort of equilibrium or long term. You're using different sets. For instance, one is just using 90-day average in MCD that we observed. Secondly, this distribution is then simplified. It's put into buckets or ranges where we say X amount of debt resides in collateralization ratio of 150 to 175 and so on. Next, simulation uses GBM process with jump risks, and price is simulated, and collateralization ratios are of course changed. But importantly, what the model does is then uses this behavior function and it simultaneously push the collateralization ratio back to some initial equilibrium with a reversion time like I described. The fifth bullet point actually has an example. So let's say you have 20% of the debt residing in collateralization ratio of 200, price drops 10%, the ratio is decreased to 180, and then Volts adjust it back to 200 by some reversion time, the one that user of course set. And this may lead to liquidations, or either it doesn't. Depends about the liquidation. About the reversion time is set. Importantly, there's always some kind of reversion to equilibrium. This depends on these reversion times. In coming days, the documentation should provide some data we've been using for inputs. We know actually that this is far from ideal for behavior modeling, so this still remains a further research. And why is that? It's because the hardest part is when you try to assess behavior, which might completely change during the simulation from the initial one. Just imagine that, for instance, collateral enters a bullish market, bullish sentiment, and the behavior function completely changes, right? Users might just want to be over leveraged, keeping low collateralization ratio. And that's why ideally you would want to model behavior more dynamically, somehow more associated with collateral price. Hopefully this is something that that's being improved in the next iteration, or future risk teams help us evolve this. Next slide, please. Okay, so this is the one last important part. The input we briefly talked about yesterday, the Maker Dilution Capacity or economic capital. This input is crucial for estimating solvency of Maker. It plays an important role when deciding about debt ceiling or liquidation ratio. So the inputs of the model we presented so far, they were needed to produce distribution of losses. And this helps us determine risk premium, but also helps us estimate the tail loss for Maker. And this tail loss is best measured by value at risk, 99.9%, for instance, and we want to be protected against. As we said yesterday, the protection comes through either DAI surplus buffer, but primarily through debt auctions. But the most important part is we need to know how much capital can it really be attracted to those auctions to cover the shortfall. And this is why we call economic capital also Maker Dilution Capacity. Now, you could basically have two approaches. The one we didn't choose, but some may, is using the market capitalization of Maker. Clearly, that's not the best approach, just assuming the pure market capitalization, because we know Maker is quite illiquid. There's also uncertainty when there's an issuance event and so on. Also, Maker is quite correlated with the asset, and when you have liquidations, Maker capitalization would of course also fall. So this remains one possibility, but it's hard to predict what there needs to be some liquidity discount assumed there, and it's not easy to calculate it. So the other heuristic we use to sidestep this liquidity and correlation issue of Maker is to create a hypothetical, very conservative valuation model for Maker token. So a valuation which would have a sufficiently conservative discount, and this would normally attract enough investors which would almost surely purchase the necessary amount in DEP auction, regardless of what the market conditions are. So please, next slide, Cyrus. Okay, so this was our approach for determining maker dilution capacity. We used discounted future cash flow analogy by using different ranges of inputs. But most importantly, we used a huge discount rate. So here's one example. We used some kind of conservative inputs, but then we set discount rate to a really high number, like 100%. Normally, VCs, put it 40, at most 50 maybe. So this is really high. What's the whole point of this is that investors buying Maker in DEP auction under such valuation, and let's say they assume all the inputs are kind of tolerable by them, they would achieve 100% yield. And the idea is this would attract a lot of money, right? This would attract enough money to cover this valuation that you just calculated. In this case, that's 28 million. Actually, we're using different ranges. Also, is going to be shared, but in this case, you are kind of implying there would be 28 million of money available to cover the shortfall, because investors would be making 100% annual return, and there's enough investors in crypto willing to do that. A short side note here at the valuation, you can see this DCF approach is truly just an analogy because it isn't quite standard. We added additional value to estimating capital. This is called Maker governance premium. The idea behind this is that this dilution capacity consists also from the value that isn't necessarily based on fees. For instance, even if Maker doesn't collect any fees, there's still substantial value in Maker's governance token, because of course it determines the overall DeFi activity and ecosystem. We don't have a valuation model for that yet. So again, very conservative numbers were used. In this case, it's 15 million, but of course, we use the range. We hope though that community future risk teams can help us tackle this problem and evolve this valuation in the future. So just to conclude this section, once we determine Maker dilution capacity, so this present value number, this is then used as kind of an input of the model. I'm saying kind of because it's actually used at the end, because when you figure out the whole distribution of losses and you figure out the 99.9% value at risk, you need to compare it with this number. And if this number is not sufficiently high to cover value at risk, you either can do two things. The first, most obvious one is just decrease the debt ceiling, and obviously you're going to produce less losses, or increase the liquidation ratio. And that's it for this part, I guess. Yeah. Should I go?
Yeah.
Cool.
Just to briefly kind of recap, at the end of the day, we've got sort of these different individual analyses. It's almost like every single step in this model could be its own substantial model. But when you roll this all together, at the end of the day, you're modeling those collateralization ratios to determine the amount of liquidation, to then produce a amount that is sold, to then recover a certain percentage of that to get final losses. And then essentially, you can see there are a lot of different individual analyses that go into determining how the collateralization ratio responds to prices, to determining the slippage curve, to determining the jump risks and how the asset price path is going to be modified for these jump diffusion processes. So at the end of the day, the model from a technical standpoint essentially has to incorporate each of these components. So what we've sort of endeavored to do from a mechanical standpoint is to essentially modularize these components into different functions and roll them all together into a cohesive technical model. So again, I'm not going to bore everyone with really individual like line item details about the code today, but just from a mechanical standpoint, the overall structure of this process, you could think of the entire model living in one big loop. That loop is run, say, 10,000 times. That's a variable number. But those 10,000 iterations of the model are effectively like simulating different worlds. There's a world in which ETH, moves from $200 to 20, and there's a world in which it stays totally flat but highly volatile. There's a world in which it goes to the moon, etc. And with regards to asset pricing, basically the approach is you don't know how an asset is specifically going to move. So you model how your particular mechanics work under all potential movements of that price path, or at least all that are statistically reasonable to model. And then you produce, at the end of the day, average values for how you think your system will perform. And then it's a generally well-accepted statistical approach to say that your system is expected to perform like so. Obviously, what happens in reality could be a potential outlier. But the best that you can prepare for is sort of the statistically predictable cases. So what we've kind of endeavored to do here is to say, okay, from a mechanical standpoint, each of these individual functions are parameterized. So your slippage loss, as Primoz mentioned, is a line. That line can be adjusted and the whole model could be recomputed with just that different line. And the idea is, if you think about this less as a very baked concrete model, and you think of this more as a extensible modularized tool for building specific iterations of the model, it starts to make a lot more sense. And so each of these components that we've kind of run through today is kind of like its own little module inside the model. And they're adjustable, they're removable, you can swap them for different approaches, etc. And you would theoretically be able to run the model. Additionally, the way the tool is kind of being structured, it's very easy to say, hey, I have this particular slippage function, for example, and I want to use a slightly different one because I think it's a better practice. Very easy to just make that change of the polynomial for that line and rerun the model. And that's kind of true of all of these things. In terms of, just to name a few examples, and they're not necessarily going to make sense to you, but if you want to change the amount of time it takes for users to make adjustments to their collateral in the behavioral analysis, if you want to change the slippage function, if you want to change the volatility of the asset price, etc., all of these things are sort of configurable, so that at the end of the day, the whole model is will still work. So if you could go to the next slide. Yeah, the starting place for this, as we mentioned before, was the asset price. So this is going to be your prime independent variable. Now, the asset price is effectively a modified geometric Brownian motion. So geometric Brownian motion, as I said before, a pretty textbook thing. There's a specific formula that exists for a log normal drift given a particular drift parameter, mu parameter, and a particular volatility sigma parameter. And so what happens is essentially every one of those lines is this random walk. You can apply onto this the jump risks that Marko was talking about. So essentially, there's a way in a kind of an unaltered sense where you can take the vanilla geometric Brownian motion function, and you can take that price path, apply a particular jump diffusion into it, and leave the remainder of the price path unaltered. So that's effectively what we've done. Is we've taken this normal, normal is a statistically charged term, this textbook geometric Brownian motion price path, applied these specific, and basically gone in and spliced in these specific jumps, these dramatic price depression events, so that the system is stress tested and is modeling cases not just where there's kind of blue skies volatility where everything is functioning properly, but also where it's modeling these sort of catastrophic cases. Because the approach that we've sort of taken is, what is the point of doing a model if it doesn't actually stress test the system? So that's where these jumps come in, is to say, well, okay, a normal statistical textbook approach doesn't actually consider these, very severe catastrophic Black Thursday type of events. And so we need to account for those, and that's where the jumps come from. So at the end of the day, asset price is a function of basic geometric Brownian motion plus jump. And this is the prime independent variable. Next slide. We then apply, as Primož mentioned, our learnings from historical user behavior analysis to produce collateralization ratios. Now, this particular graph is, this was in Primož's slide, is effectively a collection of 8 to 10 collateralization buckets. And so essentially what we've gone and done is said, well, if we were to consider that collateralization is a distribution, right? So a particular collateral portfolio does not have just one collateralization ratio. It's a spectrum of collateralization ratios. So you could represent this with basically, if you took a continuous curve and converted it to a bar chart of the area under the curve, you just create some discrete buckets. If this had 100 buckets or 1,000 buckets, it would potentially be a bit more detailed and a bit more nuanced, though that introduces a lot more complexity, maybe unnecessarily so. So we've sort of gone with a reasonable amount of granularity with, say, 8 to 10 buckets here. But perfect example is if somebody thought that that was not enough, they could go in and add more buckets and rerun the model. They'd have to wait a bit longer because it'd be a bit slower, but they could do that. And so essentially you see here at a technical level, this is actually a graph that's not just generated, this is generated by the code. So this is an actual representation of a simulation of 8 to 10 different collateralization buckets and how they would respond to the asset price fluctuating over time. And so you can see the ones that are color-coded more red are riskier, and the ones that are color-coded more green are less risky. And then you can see sort of this jump event at around day 115 or so. That jump event simulates sort of these stress tested conditions that I was talking about, where you have a sudden price drop for any one of the reasons that Marko ran through. And you can see even the less risky collateralization ratios there are driven into liquidation. And so those are the kinds of catastrophes that we want to make sure are included, so that we're considering not just all reasonable cases, but also some of the more worst case conditions. And so next slide. Essentially, if you take every individual one of the lines from the previous graph and you count up, okay, which ones went below 150%, or whatever the parameterized collateralization requirement is, because you can also, that's an adjustable parameter. If you wanted to consider a different risk profile, you wanted to consider how does the system work with 110% collateralization, then that number wouldn't be 150, it would be 110, and you could just change one line in a file and run that. Now, this sort of shows, okay, for each one of those lines, which ones dipped below 150% and when, and then they're aggregated at a daily level for these little nice and clean spikes. So these spikes are representations of liquidation events. So you could see that, you know, day 115-ish there is that catastrophe simulation. You could consider that's a pseudo Black Thursday type of event. And then if you go and you look at, next slide. If you look at, okay, still each one of the individual lines you saw 2 slides ago, not only were they below 150%, but you do a little bit more simple math still of how far below 150% were they. And that gives you effectively a new amount of collateral that is being auctioned off for each one of those buckets. Again, still done at an individual bucket level. Once you calculate how much is being sold, you push each one of those values through the slippage function. So we could essentially aggregate, okay, for a tranche of collateral being sold, how much slippage is being applied to that tranche of collateral sold. You add that up and basically you determine how much DAI would we recover for selling that amount of collateral. Once you know what amount of DAI you're recovering from the liquidations, it's a very simple subtraction to say, subtract that from the amount of debt, and that tells you basically how much you've gained or lost through that liquidation. If you're recovering less than what the debt is, that's what loss comes from. So this is a graph of the results of that calculation. Again, not generated by us, all still generated by the code. This basically is a representation of what are the end losses through those liquidation events. So you can see still that sort of day 115-ish spike that shows a pretty significant loss event because there was a pretty significant percentage of the debt supply that was being sold off on that day. If you go to the next slide. So, yeah. So now I mentioned this whole thing lives within a loop. So if you now consider every one of those iterations of the loop would spit out a different value for the sum of all of those losses. So if you took all the losses, all those spikes, added them up, divided by the average debt supply over that time period, you get on a percentage basis what you expect your annualized losses to be for a given DAI supply. Now, every one of those runs spits out a different value. You plot those into a distribution, and then you take this and you can now generate one of 2 calculations off of it. You could look at the average, or you could add up, you know, some cutoff of the tail and look at the area under that tail. That's where you get the value at risk and expected loss calculations from. And those are basically the values that you would use to back into, is that economic capital sufficient to cover the area under the curve of those tails? In other words, is the debt ceiling safe or not? And then you would also use the average expected losses to back your way into how much of a stability fee or risk premium is appropriate to cover that loss. Now, if you go to the next slide, I mentioned that the model is parameterized. So if you want to adjust what you think is an appropriate volatility parameter for ETH, or if you want to adjust the collateralization requirement, or if you want to adjust the particular slippage curve, etc., you can do so. And basically, each one of those different parameters would now spit out a different value. Well, you could graph many different runs of multiple different changes of parameters, this is just for our brain's sake, a visualization of changing 2 parameters at once. Or sorry, 3 parameters at once. No, 2, yeah. The sigma and collateral. Sorry, I tripped myself up for a second with all the dimensions. So if you were to change 2 parameters at once, collateral cutoff and expected volatility, this produces a plane of different gains and loss values. This is just the average expected loss. And it helps to visualize and understand certain patterns of, okay, these parameters are more or less important. These are the relative interactions between these parameters, which is a helpful facet of the approach that we've taken here, is to be able to see the interplay between these variables. So at the end of the day, there's no one specific right answer here of this is the exact expected loss value. It is for a given combination of parameters, here is sort of your average expected losses. And there's a lot of extensibility and there's a lot of flexibility here for different analysts to sort of come in and say, hey, I think this parameter should actually be this value. And then you can go back and look and say, all right, well, this is the expected output then. And so this is sort of a nice graphical visualization of a table of results. I think that's it. Next slide. Yeah.
Right. Thank you very much, Vishesh, Primosh, and Marko. You guys did an incredible job. I realized that was an absolutely enormous amount of information. That's okay. I think in the weeks to come, we will definitely be tackling more of the intricacies or nuances of the different components of the model. I've kind of developed just a list of discussion questions or discussion topics for the community to consider. We of course don't have to run through all of these right now, but happy to chat for a little bit as well. Just want to be conscious of the time as well. So, okay, let's start from the top. So, how does this relate to collateral onboarding? The methodology that we've outlined today should, in theory, work fairly nicely with most crypto assets. You can basically take the trade history, you can do a fundamental evaluation of the asset, you'd have to parameterize the jump risks a little bit, and then all else equal, you can probably come up with a solid package of risk parameters. The lagging factor in the process is that fundamental evaluation. So for the community or our team or anyone to kind of dig deep into the asset, learn the, just do a due diligence, and then be able to kind of give a qualified or competent evaluation, right, that would take a while. Once that's done, everything else can be done fairly quickly. So one potential suggestion for governance is if urgency and speed and growth and scale and all those kind of business objectives are top of mind, then we could maybe outsource a lot of the fundamental evaluations to community analysts, to third-party research firms, and so on. And then we can kind of collaborate with these people and put out a risk construct or risk package for the community. In terms of centralized assets, of course, they require a little bit of extra legal work, which is still kind of a gray area. But from a quantitative perspective, what's important is that potentially the loss distribution is bistable. So what that means is basically you have no losses or you have enormous losses. So instead of having like a somewhat smooth distribution like this, you would just have all of the losses bunch up towards the left side. with very little in between. And that's obviously a concern. And so I think kind of one heuristic the community is aware of, at least as it factored into USDC, is to generally start with lower debt ceilings, right? Until we have some further regulatory clarity. In terms of diversification and correlations, obviously diversification is one of the key risk mitigating concepts in all of MakerDAO. But this is going to be a little bit confusing to the extent that we're dealing with crypto assets and not traditional real world histories. The key concept here is that when you think about correlations, you're not necessarily thinking about price correlation, but what you're actually thinking about is the correlation of a vault from two different collateral assets defaulting at the same time. So a simple example of how this could trip people up. Recently, there's been a lot of discussion in the community about adding a tokenized gold from a company called Paxos. Paxos, I believe, also has a USD stablecoin product called Pax USD. In theory, Pax Gold and Pax USD, in theory, the gold price and the USD price should be fairly uncorrelated. But given that both of these tokenized variants are both handled by the same company, there is a very strong correlation in the correlation risk of the counterparty default. So this is where we need to be careful in saying that even though Pax and even though gold and a stable coin are uncorrelated, Pax USD and Pax Gold do share a default correlation. And how to parameterize this concept is definitely going to be challenging. But in the meantime, I think I don't think this is a significant concern at this point, but definitely something for discussion. In terms of subjective inputs, so a lot of the methodologies we described today, jump risks and liquidation discounts, they're quite, they're very important concepts, but there's no clear-cut one-size-fits-all methodology for this. So we have to take the results with a grain of salt. We have to incorporate some subjectivity in the science behind it. And this is, in some cases, one of those issues where the risk team will be forced to, or any risk team will be forced to work in conjunction with the community for some input on how some of these parameters should be calibrated. Moving on, for policy, yesterday we talked a little bit about DSR spreads and surplus buffers and all these kinds of parameters that are, again, the model and the risk tooling can help the community quantify its views. But what those viewpoints may be as inputs is going to require some collaboration as well. And then lastly, well, actually, this is kind of continuation of what I was just talking about, but yeah, things like the surplus buffer, if it should be held in DAI, if the DAI from the surplus should be pre-minted, if there should be other assets in the reserve, and whether those should be on-chain or off-chain. Can Maker remain competitive with higher collateral requirement? This question refers to the fact that if Maker does not have sufficient economic capital or buffer on hand, then potentially it may need to increase the collateral requirements through the liquidation ratio, which would in theory, could make her less competitive in reference to competitors. And yeah, that's it. So a lot of these questions, they're obviously not for today's discussion, but we should try to make some forum threads out of some of the most important topics of these and do some good governance through that. And yeah, as I said before, in the weeks to come, we can kind of tackle some of the concepts from today individually and start to build out even more detailed framework for risk. All right. That being said, if anyone has kind of a few quick questions, happy to answer some things right now. In general, I'm guessing, given that we're 90 minutes into this call, might be a good idea to just cut the call off, and then we can kind of just mull these concepts over and chat offline or on the forums.
Doesn't sound like that.
All right, then. Want to thank everybody again for coming to the Wednesday governance call. I want to thank Vishesh, Primosh, and Marko. And yeah, hopefully see all of you guys on tomorrow's governance call again.